Hey, what's up YouTube? This is Foxtel Digital coming to you again with Black Girl Stocks, and this is another segment of our top 3 option plays for this week. So we're going to go over a few profitable trades, stock fundamentals, and then strategies that you can do to make it through. But first, if this is your first time watching this video, please click that thumbs up button. It really helps the channel. Also, make sure that you subscribe and click that notification bell so that you get notified anytime I upload a new video for you guys. So the first stock that we're looking at is LULU, and this is Lululemon, currently trading at $368.47 per share. Don't be scared of this high number. You know, with doing option plays, it's always going to be cheaper than actually buying those 100 shares. So if you see right now, it's at $368. Just coming in, looking at option contracts. So if you look at an option contract, it's, you know, maybe a week or so away. So it would be about $500. So I mean, to have control of 100 shares, you know, if you were actually to buy those shares with this, that would be about $36,000. But for $570 for this contract, around $500, you can have control over 100 shares. So this is just one that is also on my day trading options list. This is one of my 25 that I have on there actually. So it's just something to think about. Just know that this company, this is a retail company, and they sell $100 yoga pants. Lululemon in Maryland, there's that one crazy girl, Brittany Norwood. I don't know if she's related to Brandy, but she killed her store manager because she got caught stealing those $100 yoga pants. It's just always something that I think about when it comes to that company, because that's how I initially found out who they were and what they did. So I just kind of think that's pretty cool. But the reason why I'm really liking this stock right now is because it's getting near a buy point or zone. We have a buy zone around 386 right now. And we're going to see that a lot in a lot of retail stocks because more and more people are getting vaccinated. Restrictions are being lowered as the pandemic seems to be slowing down. So people are going to start buying more clothes, going out to restaurants, movies. And you already know we outside, baby. We outside. We're outside. Right now, the apparel and consumer sector is trading above the S&P 500 range. So right now, it's up 4.78% alone in the last 3 months. In the short and long term, this is going to be a great buy. It's really giving bullish signals. And then when you have 10 analysts increasing their earning estimates in the last 60 days, that's also a really good bullish indicator for price movement. And they also have earnings projected to increase by 46% by the end of 2021 alone. They have a larger volume on their stocks ask versus their bid. So, hey, that's another bullish signal. We have a target range up, you know, upwards around here. So around, you know, like we see, it's trading at $368. So that alone is a possible $20 increase in the near future for this stock. So good strategies for a stock like this would be a long call play or a call debit spread, or even a put credit spread, because these are all to collect premiums, and these are all going to be bullish plays. And then looking over here at the options, this stock does have weekly options. So they have weekly option contracts. So, you know, if you did want to do a long call, you know, it wouldn't be too expensive for you. Or if you wanted to do something that would collect premium, you would have, you know, shorter time frames and, you know, then a greater loss time decay for those. So let's just get into Robinhood really quickly for this. So let's go to Lululemon. So you see that trade. So for a put credit spread, you can pick something that expires on Friday if you wanted. And so what's good about this is it's going to limit your profits, but it's also going to limit your losses. So that's why I like to do spreads. So let's go over to put. And so for this, let's go back to the chart. You see, this is our price target zone. And right here at around $356, kind of have a little stop loss here. So if it goes below that, because you've seen in the past, you know, it has tested, this white line, this is the 50-day moving average. It's tested that before. If it, you know, bounces off of that, that's going to be a good signal that we're continuing upwards. But if it does drop below that, then that's not the best sign. So it could be going into bearish territory, or at least a good correction, which we don't want. We want to continue this upward trend to, you know, that 380. What's up? For that reason, this would kind of be our stop loss zone, our lowest it'll go area. You can sell your put around 355. So sell the 355 put, and then you could buy the 350. And this is going to give you a put put credit spread. So you're going to be receiving a total credit of $26 for this. And then I like down here that it shows you your maximum profit is going to be $27, but the most you can lose is $400. So it's kind of a lot, and you would start to lose that if it goes below. So if it goes below 354 by Friday, then you would start to see this loss. So for that reason, to get out of this spread, so if you don't want to lose more than 10%, cut it at 354 for that. And then also keep your eye on the indicators. Also, the RSI indicator, over time, it has been giving an increase. So you see that the stock is in an uptrend. You have an uptrend with your RSI, small correction, but it could continue upwards with that. So those are bullish signals, but make sure you have stop losses with these. So you'll receive the full credit as long as the stock stays above $355. So it's $368. You'll keep all of that as long as it stays above that by Friday. So that would be a put credit spread. Or if you wanted to do something a little bit less risky, because that was a large loss for that, you can do a long call. So this is going to be less risky. I would pick an expiration date that's a little bit further out, so maybe July 23rd, but the only thing is these are going to be a little bit more expensive the further out that you go. It would be $800, so this would be about almost $1,000 investment for this. But the thing I would like about a long call position for this stock is because the stock increases so much. So let's zoom in a little bit on a 5-day chart. So just looking at this stock, I mean, it's nothing for this stock to go up a few dollars in a day. So just last week, or excuse me, on the 2nd, the stock went from around 364 all the way up to 369 in one day. So that's not that bad. Then you look here, it can also drop a lot, 368 down to 365. So it's going to move a few dollars a day, but the stock is in a steady uptrend. So yeah, if you're going to do a long call, you know, that's what you would pay for that. Or if you wanted to do something that's cheaper than doing a long call, you can do a call debit spread where you're still going to be paying a premium, but it's going to be a lot less than just buying a long call. And then also you'll have a max profit and a max loss with this too. So to do a call debit spread, you can do something like, I would have an expiration date that's a little bit closer, maybe July 9th, buy 360 and then sell 362.5. So that's going to be a call debit spread. So for this one, you're going to be paying for this. You're going to be paying $182. So this is going to be a lot cheaper than, you know, what we looked at for the long calls, which would be around $800. But you're going to have a maximum profit of $67 and then a maximum loss $180. So this is a lot cheaper and it's a lot less risky than doing a long call. Because the most you can lose is $183. So if we were doing one of the long calls, the most you can lose with that is $800. But you know, the profit is infinite. But this is a lot less risky. I like doing call debit spreads. So this is something that you can do short term. So as long as this stock goes up, so we need this stock to go up at least to 361. So at expiration, if the stock is at $361, so right now it's 368. If it dropped down to this price by expiration, you wouldn't have lost anything. But before that, you know, you would like for it to increase and you would get that 67. So that's the most that you're going to get with that, as long as it's increasing in price above where it is now. And so you can see here, you know, this is $100. So imagine, you know, if you had 8 of these, about 5 of these. So this would kind of be, you know, the amount that you would pay for one long call. But with this, you can have 5 debit spreads, pay about $900, and then you have a maximum profit of $300, but you can lose that $915. So, I mean, it's just something to think about. And next we have LEVI, and this will be our first earnings play for this week. And so this is where we're going to anticipate taking advantage of implied volatility, gap ups and crushes. Also, if you haven't watched my video with more information on doing trades during earnings, then I'll leave a link to that below. Make sure you check that out. But yeah, so we all know, you know, we all know about Levi's. We know what Levi's is. They're famous for amazing quality jeans. And so they have an earnings report scheduled for Thursday, July 8th during the after hours. So this earnings play came from Tiblio. So if you haven't already checked out Tiblio, I'll have the link below. But they give daily option plays with earnings, bull and bear squeezes, long call plays, credit spreads, and everything like that, volume gap ups. So definitely make sure you check them out. And when you do, use my link for 20% off of your first month. So this stock also has higher volume on the ask versus the bid, which is definitely a short-term bullish indicator. Looking at the MACD indicator, it does look like it could have an upcoming dip, or it's pretty close to possibly having a dip, but it's kind of hit or miss. And then looking at the RSI indicator, you see the past 2 cycles, it hasn't gone above 66. So we'll kind of see if this upwards trend is slowing down and if it's going to turn into a downtrend. So for Levi's, going into earnings, more investors are expecting for sales to increase 150%. And then this is also going to be its first major growth pattern seen in the company since the start of the pandemic. They have an earnings on July 8th. So let's zoom out a little bit from this. All right, so we have a few days to see how this plays out. And then looking at Tiblio, they're 40% neutral and 40% bearish on this. So if you wanted to, see what happens, and then also looking at previous earnings. So looking back at, let's look at this earning back on January 27th. They had an earnings report of 0.138 and it was actually 0.2. So, but that still dropped. It dropped from around 21 to 19. So the price movement after the earnings wasn't too much for that. And then let's go to the next one, the most recent. And this was on April 8th. But yeah, so after that, the stock rose from around 24 to 26. So it's a couple of dollars in between moves. And then also looking over here, our market maker move is around $2 for this. And this is expected by July 16th. So the stock looks like it has a pattern of moving around $2. So you can use that as your zone limit, around $2, but I want to be safer and I'll probably spread the legs a little wider. So if you're looking to do something with this earnings play, being it neutral or bearish, you can have your legs around 29 and then around 24.6. So if you're gonna do an earnings play, with this, you could do, like I said, you can do an iron condor. And so for all right, so for your call side, you could sell the 29 and then buy the 31. And then for your puts, you could maybe sell 25, sell the 25 put, and so this is gonna give you an iron condor. So you're gonna have a total credit of $60 with this one. And as long as the stock closes in between your sells, so as long as it closes in between 25 and 29, then you'll keep that full credit. Or if this iron condor drops in value, so let's say if you're getting $60 credit with this and it drops down to 0.2 in value, then you can buy that back and then you'll just keep the difference because you're selling this and you're receiving premium. But the most that you can lose with this, if it passes either of these break even legs, is going to be $140. Or excuse me, if it goes past your buys. So if it goes past $31 on the call side, or if it goes below $23 on the put side, then you would lose a maximum of a maximum of $140. So this really isn't that bad as far as what you can gain versus a loss, versus if you were just doing a one-sided call or put. So this is pretty cool, especially for an earnings play, and the expiration isn't so close, so we still have time to see it move in our favor. So this is pretty cool. If you bought 5 of these, you'd receive $300, but you could also lose 7, so how risky do you want to be? How risky are you trying to get? That's all. So that's something that you can do for that. Okay, and then the last option play this week is going to be INFY, and this is Infosys. This company is doing great. They just signed on someone new to their board of directors. So they're constantly improving themselves and very innovative. But this is a company that's in the technology sector, and it does a lot of consulting work. So it does a lot of consulting work, and it does a lot of consulting and outsource work for large businesses all over the world. Okay, like application development, in management, system integrations, and things like that. So it's doing really well. Basically, in layman's terms, Infosys is a service and consultancy company. And this is also going to be another earnings play to look for next week, okay? And this is also going to be earnings play to look for next week. So you know we have a short trading week after the 4th of July holiday. So they're going to have an earnings report on Wednesday, July 14th, and it's going to be in the morning pre-market hours. So just a little bit of news that's going on with the company right now. The company began collaborating with Arc Rock about a month ago. And so these type of partnerships can lead to possible increases with newer technology expansion and demand for digital services like this company, Infosys. And then just looking at the stock chart, it's been in a consistent increase. This is even back since November. So back here, we're looking at it, it's $14. Right now it's 21. So it's not huge jumps, but it is continuous gain. And then also just a little bit on the ends of the company. It has a pretty good PE ratio of about 34.54, so that's good. And then an EPS of 0.61, so that's really good too. So they have an earnings play, and you know, we'll just kind of see. We're honestly pretty bearish on this, especially because they're adding on new board members, they're having collaborations, and it's just very innovative. They have a lot of good, smart people working for them. I know somebody beautiful and smart that works there, so obviously they're doing good picks. Looking at our RSI indicator, we're kind of see where she goes, but overall she's in an uptrend. So if you were going to do something with this, and then also another reason why I picked this is because on Tiblio, this has a very high. So let me bring Tiblio over here. Looking at Tiblio, this company is 70.59% bearish right now for their earnings. So that's a really good sign also. So for that, you can do a long call, or you can do something like a put credit spread where you receive credit. So all right, so if we were going to trade something for the earnings, we have an earnings on the 14th. So I mean, you could get something around there, or if you want to be, you know, kind of safe and give yourself some time, click something further out. But if you were going to do a long call, you can pick something that's in the money. So this is going to be fairly cheap. And then, you know, you probably want to have more time because of the loss and implied volatility. So a lot of times after earnings, even with a good earning report, your option contract will lose value. So very quickly with that IV crush. So it would be safer to pick something further out. And because this is a lower price stock, it's not that expensive. So it's about $80 per contract. But this is good because, you know, if you were having 200 or 100 shares of this, that'd be around over $2,000. So this is pretty good, pretty reasonably priced. Do something cute like that. You know, maybe get $400 maximum profit, unlimited. It just depends on how far the stock goes. And then looking even at your Greeks, the Greeks are okay. 0.5 delta is okay. Gamma is cute, 0.2, and you have a very low theta. So this is pretty cool. Looking at the ask and the bid though, it's giving bearish signals with this because you have a higher volume on the bid. So that's something to kind of think about with the long call. And then another strategy that we can do with this would be our put credit spread. So this is where we're going to be receiving premium. So you could even, I mean, if you want to be safe, and it's consistently been trading above the 50-day moving average. But if you want to be safe, you can kind of cut your losses maybe around 18. So we can go down here, but you're going to get less money. So especially not for this time frame, for this close. But if you wanted to make more money, you'd have to go further out. So like if you went further out, it's still not a lot. So you can sell around 20 and then buy at 19. So then you would have a credit of $7, or excuse me, a maximum profit of $8, but a maximum loss of 92. That doesn't even seem worth it. But you can do more contracts to make more money. So you can do 5, but you'd be risking $400 to make $40 and just kind of see. So that's something that you can do also. And then also maybe if you wanted to do, like if you wanted to do a spread for this, maybe you can have your legs maybe up to 23, close it there. So just do that. So let's go up here to our call area. You're really not going to get much. Let's say if it closed in between 24 and 25, and then for our puts between 19 and 18, we still be getting $5 maximum loss 95. So that really doesn't seem worth it, but it's something that you can do. Honestly, I think the most profit would probably be a long call for this if it does have a great earnings and the stock does increase. So, but yeah, this is gonna be pretty short for this week. It's been a pretty short week, so we'll see what happens with, you know, coming off of the holiday. So we'll see with that, but yeah, so that's pretty much all I have for this video. If you found any value in this or any of our previous videos, please make sure you click that thumbs up button for your girl. Also subscribe, click that notification bell, and I'll catch you guys on the next video. All right, and I'll catch you guys next week, and I'll catch you guys for our next top 3 option plays of the week. All right.